This podcast is brought to you through our charitable partnership with Children's Home Society of North Carolina. Right now, there are more than 12,000 children living in the foster care system and not nearly enough safe, loving homes for them. Find out how you can make a difference today at chsnc.org.
Welcome to the Semmax Way, the definitive podcast for mastering finance, investment, and retirement planning. Prepare to unlock the secrets to financial success as we delve into lucrative investment strategies and provide expert guidance towards a secure retirement. With over 20 years of experience, Semmax Financial Group has been dedicated to serving investors, and through this podcast, we aim to empower you with the knowledge to maximize your savings and achieve lasting financial freedom the Semmax Way. Whether you're a professional finance enthusiast, a high net worth individual, or part of a sophisticated investment group, this podcast is tailor-made for you. And now, here is your host, Matt Landon, financial advisor for Semmax Financial Group and licensed CFP.
Hello and welcome, everybody. Today, I want to talk about something that you've probably heard about, but you may not fully understand, and that is life insurance. Now, when we talk about life insurance, I want to explain just a little bit of what life insurance is, kind of how it works. There's a lot of different types, and there's a lot of different ways you can use it. You may have heard people talk about tax hacking or loopholes in the tax code and how you can use life insurance in those regards. And so I'd really like to dive in and explain a little bit of what that is, how that works. So first of all, let's talk about life insurance in general. Now, when people talk about life insurance, you talk about the death benefit, you talk about the cash value. Generally speaking, when people are talking about life insurance, if you don't know all the different types, you're probably thinking of a term life insurance policy. What that means is you put in a certain amount of money every month or every quarter, annually, kind of however you have it broken down, but you're paying a certain amount of money every year. And then in exchange for that, if you pass away within that time frame that the policy is active, it would pay out a large lump sum settlement to your beneficiaries. Now, here's the thing to keep in mind with the term policy. It's going to be the cheapest option. So if you're a 27-year-old and you have a spouse and little kids at home and this really expensive mortgage, and you also have car debt, a life insurance policy is a way of replacing your lost wages should something happen to you. That's why a lot of companies will have a large umbrella policy where it's either 1 or 2 times your salary, maybe 3 times your salary, and you can opt to pay for more. What they're basically doing is they're looking at you and underwriting you against a number of other people. Now, underwriting, what is that? Long story short, the insurance company is making a bet that you're going to live longer than that policy, that they're going to make money off of you and they're not going to have to pay it out. Now, there's always a chance that you will, but you do have to go through an underwriting process. You have to answer a questionnaire. You may have to go through a medical exam, have your weight, your height, take lab work, do a little bit of have your blood pressure taken, things of that nature. And what they're going to do is they're going to say, okay, you come back as super preferred. You are an incredibly healthy person. We think this is amazing. It is not going to cost you very much for that life insurance. But for other people, they come back and they say, all right, it's going to be a little bit more pricey. You came back as standard or substandard, or depending on your health and your condition, you may not be able to get underwritten at all. Now, where this applies is, again, a term policy. You're paying a little bit. You're not paying a lot of money. But if I have a 10-year term policy, in that 10 years, if something happens to me, my wife gets a death benefit. Or my beneficiary. In this case, it's my wife. I'll be honest. It's my wife. But if something happens after that policy lapses, after that 10-year period, and I pass away, well, she doesn't get anything from that policy. The policy's done. That 10-year period is over and done with. So if you get that policy when you're 27, when you're 37, it's no longer in effect. You have to get another policy. And what happens is at 37, your health may not be quite as good, but statistically speaking, there's a higher chance of you passing away. And what that means is the insurance becomes more expensive. So if you just keep getting 10-year term policies, decade after decade after decade, you're paying more and more with no guarantee you're going to get anything out of it. Now, here's where you can use it as more of a investment vehicle. you're not going to use a term policy. You're going to use an indexed universal life policy. And what you want to do is you want to overfund that account. So what happens with an indexed universal life policy is you're paying for the premium, but what you do is you're overfunding it. You're putting more funds in than you need just to get that death benefit. So usually with a term policy, I want to pay as little as possible, and I want to get the largest policy death benefit I can. If I can get away with giving you $25 a month and I can get $500,000 of coverage, that is so much better than paying $45 a month and only getting $500,000 of coverage. I'm getting more coverage for less money, or the same coverage for less money, right? The idea behind a term policy is to try and pay as little as you can to get the most death benefit possible. Because aside from the death benefit, the policy has no value. Now, when it comes to an IUL, when you're using it from an investment standpoint, you're flipping that script on its head just a little bit. You actually want to overfund the account. I want to pay as much in premium as I can get away with legally without running into issues with the IRS or the tax man or anybody else, while getting the smallest death benefit possible. Because what happens is the difference between what you're paying for that death benefit and the additional cash that's going in settles into a cash account. That uses indexing. It's looking at the stock market to generate returns. If the market's up, you make something. If the market's down, you don't make anything. So what happens is that cash value starts to accumulate and it starts to grow. You're overfunding it year after year after year. Now, here's the thing. You can't lump a huge amount in all at once and expect things to be okay. That's called MECing a policy. MEC stands for a modified endowment contract, and you lose the tax benefits you're looking for. Now, we can do a whole podcast just talking about MECing a policy, but we don't need to get into that for the moment. But the big thing here is you want to put an amount in that you know I can afford to pay this for the next 7 to 10 years. And then you're overfunding that account for the next 7 to 10 years. Now, if something happens to you in that first year, guess what? It's a life insurance policy. You still get that death benefit for your beneficiaries. In year 10, it's still a life insurance policy. You still get that death benefit for your beneficiaries. So you haven't thrown that money away, but you are paying an awful lot for insurance. But the cash value that's inside of there is continuing to grow. As it continues to grow and develop, down the road, what you do is you take loans against the policy. You're not actually withdrawing the cash. You're simply taking a loan. And because you're taking a loan, there's no tax consequences to it. Now, you got to make sure you follow the rules. You want to talk about it with your advisor. You definitely want to talk about this with your tax preparer, whether it's a CPA or otherwise. Make sure you do everything according to the way it's supposed to be done. But what you can do is you're taking those loans, you're getting that cash out tax-free. So what you do is it's basically decreasing the cash value inside of there. It's decreasing the death benefit, and eventually it comes null and void. Well, you just don't pay the loans back, and eventually that contract gets canceled. But you pulled a huge amount of money out tax-free. So a lot of people talk about it like a tax loophole or a Roth account on steroids. Here's the thing. I don't think this is the first place you should go from an investment standpoint. I think number one, you should be maxing out your Roth. You should also be looking at maxing out your 401k, whether that's pre-tax, post-tax, depending on your tax situation. You should also have a large non-qualified account that is developing. But once you've done those things, if you're looking for another place to store some of your funds from an investment standpoint, that's where an IUL can make sense. Again, there are rules. You have to follow the rules. You can't just do it all nilly-willy and expect it to work out. I'd like to pause a minute and just express our gratitude to our podcast sponsors, Noble's Food and Pursuits. This renowned restaurant group has been serving the community for an impressive 40 years, starting with Jim Noble's original restaurant, J. Basil Noble in High Point. Over the years, their passion for hospitality has flourished, leading them to expand into a diverse collection of 9 restaurants, a retail bakery, and a catering company. Today, we want to shine a spotlight on one of their beloved establishments, Rooster's A Noble Grill, which has been proudly open for 31 years right here in Winston-Salem. Now, Roosters is known for its commitment to offering a seasonally inspired, regionally cultivated menu featuring mouth-watering wood-fired meats, poultry, and vegetables. If you're looking for a delightful dining experience, they also host monthly wine dinners and provide live music on their inviting patio every Tuesday night. Now, make sure to pay them a visit at 380 Knollwood Street, and to secure your spot, head over to theroosterskitchen.com and make a reservation. Again, that's roosterskitchen.com. Trust us, you won't want to miss the delectable dishes and warm ambiance that Roosters has to offer. Now, let's continue exploring the world of finance and uncovering some strategies to help you achieve your financial goals. So remember, when someone's talking about life insurance as an investment vehicle, what they're really talking about is overfunding a life insurance policy and then taking loans out of that policy down the road. There are situations where it makes sense. There are cases where I've helped clients go into this product. But something you want to keep in mind is, does this make sense for me? There's a lot of investment choices out there, but whether or not it's the right one for you is going to depend on a number of key things. And so if someone is coming to you and they're saying, you should be doing this IUL, it's a great investment vehicle, this is how you should be investing your funds, it's not the perfect investment vehicle. And especially if you haven't done what I already said, if you haven't paid into that Roth, if you haven't already started maxing out your 401k, if you don't have a large non-qualified account, whether that's between you and a spouse, just you on your own, a trust account, if you don't have those after-tax dollars, access and investment in a more liquid standpoint, you probably shouldn't be throwing all of your money into a life insurance policy where if you cash it out early and cancel the policy, you're definitely going to take a hit because you've been paying for that life insurance coverage. But in certain circumstances, I think it can check an awful lot of boxes. Now, another way that you can use life insurance, aside from trying to do it from a tax hacking standpoint, is you can use life insurance from a long-term care perspective. I actually like life insurance from that long-term care perspective in the right situations. Again, and this is the key thing I'm going to probably be preaching 100 times in this podcast, is that it's situationally dependent. But long-term care, for those of you that don't know, long-term care is a policy that you fund and you pay and you pay and you pay, and they have the ability to raise the premiums or the cost on you year after year. And what happens is when you go into an assisted living facility or a rehab facility, provided you follow the restrictions and the rules that they have in place, it will pay for coverage in that facility for you. Now, some of them will pay for outpatient, some of them will not. It's very situationally dependent. It depends on your contract. But something that I've seen over and over again is folks will get a long-term care policy. They pay into this long-term care policy and they just keep raising the premiums on them. And eventually folks go, I am sick of this. They cancel it. And 2 years later is when they need it. They would have been better off never paying those premiums in the first place or sticking with it the whole time. But we don't necessarily know whether we're going to end up in a long-term care facility or not. There's a lot of variables that come into play here. So another option, and this is what I like, is to utilize life insurance. Now, when you're utilizing that life insurance, what you're basically doing is you're making sure you have a policy that has what's called living benefits inside of it. What that means is if I have a life insurance policy with a $300,000 death benefit, I might be able to access a huge percentage of those funds, say 92% of those funds, while I'm living to pay for long-term care tax-free. What I really like about this is it means that money that I'm paying for this policy, either I'm going to use it for care while I'm living. Put yourself in those shoes. You're saying if I need it, it's there for me. But if you don't need it, if you don't end up using it, it's there as a death benefit for your loved one. It's going to your beneficiaries. Now, whether that's your spouse, whether that's your kids, grandkids, your alma mater, whether that's a charity that you want to support, you have discretion over where those funds go. But unlike some long-term care policies, with this life insurance, you at least know either I'm going to use it or my loved ones or where I care for it to go is going to get the benefit, but the money's not being thrown away. Those premiums are serving some kind of purpose. So those are just a couple ways which you can use life insurance I think there are other options as well. We don't need to necessarily get into everything, but I'll leave you with this one last thought. You might be in a situation where between you and your spouse, one of you is a little bit more healthy, the other one's not quite so much. You could utilize or look at using what's called a second to die policy. This is a specific type of policy where the underwriting is actually done on both of you. It's done on a couple, and it pays out on the second person's passing. So you might be in a situation where between the two of you, you could get a larger death benefit coverage without having to pay a huge amount out of pocket. That's pretty cool. I really like laddering life insurance with some kind of an annuity that is used to pay the coverage. So that way, I've got this annuity. It kicks off this much in income every year. That's used to pay the premium. I've got a guaranteed death benefit, and I don't have to worry about trying to come up with the income somewhere else. Other people like to self-fund, or they use particular stocks that they have that kick off dividends that they know that's going to be enough to cover it. There's a lot of different ways you can do it. I think the key thing with life insurance is if you're a little bit older, just realize there's different ways it can be utilized. It can be a huge blessing. You could even, especially if you're in your 20s, doing something like an IUL with the plan on doing that growth standpoint and then doing the tax loophole, if you will, to pull it out later, that could be used as a gift. You could use to help support someone where you didn't want to directly give them cash because you feel like, well, they may not be responsible enough to utilize it, but I still want to bless them with it. Well, you can't open a Roth account for them, but you can help them out with insurance. So it's something to consider. The big thing there is there's a lot of ways you can do it. And I think it's really important that you're working with a fiduciary. When you are working with somebody who is not a fiduciary, oftentimes when they're talking about annuities and life insurance and long-term care policies, they're looking at you and all they're seeing is a big fat commission. If they can get you through suitability, they're going to make their check and walk out the door. They're not looking at it from a fiduciary standpoint. And I think it's so important to do that because a fiduciary is going to look at things and say, what is in your best interest? What makes the most sense for you? Not how can I get the biggest commission out of this person possible? So that's where I was saying all of these are products, all of these are options that under the right circumstances make sense, but they don't make sense for everyone. They don't make sense all the time. It's got to be situationally dependent and it's got to be appropriate for you. I hope this has been beneficial. I hope you've enjoyed it. I've been enjoying doing this. That said, if you have more questions about life insurance, if you have different things, drop a comment, leave a review. Let me know what you think. I would be glad to do some targeted podcasts on different topics. Just let me know what you think and feel. On behalf of the whole Semmax team, I'm Matt Landon. It's been a pleasure, and I hope you have a beautiful day.
Thanks for joining us for another episode of the Semmax Way. If you're not completely satisfied with your current financial advisor, give us a call for a second opinion. Please note that this podcast is intended for informational and entertainment purposes only. The content shared on the Semmax Way should not be considered as investment advice. It is always recommended consult your licensed investment representative and a competent tax advisor respectively for your fiduciary needs and plans. No statement contained in the Semmax Way podcast or made by its producers, sponsors, host Matt Landon, or Semmax Financial Group is a recommendation. Semmax Financial Group and Matt Landon are not responsible or liable for investment value loss of any kind from any action taken based on information discussed in the Semmax Way podcast. Any opinions or viewpoints in this podcast are shared for information and entertainment purposes only and are not financial advice. We do encourage you to conduct further research and seek personalized advice for your specific financial circumstances. Full disclosure available at semmax.com/podcast. Thank you for joining us, and we look forward to having you tune in for future episodes of the Semmax Way.